So a conventional loan. Conventional loans are different than other loan programs in that ideally it is going to give you, if your credit score is in the 700s, it's going to give you better pricing options. So what that means is, if you're like most people, maybe you don't have 20% to put down. There's a common misconception. A lot of people may think that you have to put 20% down to buy a house, and you don't have to. With a conventional loan, you can put as little as 3% down and still get into the new home that you're looking for. Now, the good thing with conventional that is different than any other loan program is that once you have 20% equity in the home, the mortgage insurance premium is going to drop. So if you put less than 20% down, part of your monthly payment is going to include mortgage insurance. And that simply is called MI, mortgage insurance, or PMI, private mortgage insurance is what it's referred to as. And a lot of people, once you have 20% equity in the house, that PMI is going to drop. Well, actually, it'll go away at 22% automatically. But at 20% equity, you can write a letter to your mortgage servicer, and that premium will drop now. So what that means is simply your payment's going to go down. So it's going to save you some money. Whereas with other loan programs like FHA or USDA, that mortgage insurance premium that you're paying every month, it's on for the life of the loan. So you're going to have to keep paying it or refinance out of it. So you might not be in a position down the road to refinance. So it's an important thing to consider, and it's one of the reasons why we look at and we go through the happy method. It's why we go through and look at your 3 pillars so that we're making sure that you're going to get the best option, right? Is the conventional loan even a good fit for you, right? So the main benefit is that mortgage insurance dropping once you get 20% equity in the house. And also too, if your scores are over 700, really a 680 minimum, right? 680, you're gonna get a better interest rate, and the actual affordability of that mortgage insurance premium is going to be better. It's gonna be easier for you. It's gonna be just overall, much more what you're looking for to keep things simple. And a lot of times too, when you're looking to put an offer in on a house, another major thing with conventional loans is that they're less picky with the condition of the home. Like FHA, since it's a government program and it's ran through HUD, which is the House of Urban Development, they have more strict guidelines. So let's say you're trying to get a house and there's peeling paint under the eaves, or there might be a hole in the sheetrock. FHA, once we have to order an appraisal, we'll talk about that in another video. Once we have to order an appraisal though, then we need to, they're gonna look at that, they're gonna flag it, right? So if you go FHA and the condition of the house is not as good, well, with conventional, it's gonna allow you to it's a lot easier, right? Those guidelines are a lot less strict. So when you're putting an offer in, especially if you're in a super hot seller's market like we're in right now, and you have 5 or 10 other people that are putting offers in on houses, and one person is putting in at price and they're doing conventional, and you come in with a government loan program and the house needs a little bit of work, it's definitely not going to be as appealing. So that's another benefit with conventional, is that, like I said, we can go as little as 3% down, right? And that the money can be gifted. You can get it from 401k. You can sell Bitcoin. You can get the money you can source from different places. It doesn't have to just be in your checking account. And it mainly is just going to be an overall better program if your credit score is higher. So hopefully that answers some questions on the benefit of conventional, what a conventional means. Conventional takeaway, conventional simply means your scenario meets normal Fannie Mae, Freddie Mac guidelines. Those are the private entities that basically buy your mortgage and sell it to investors. So we just want to make sure your scenario fits their guidelines, the conventional guidelines. That's why it's called conventional, and you're good to go. So hopefully that makes sense, and we'll see you in the next videos.